Today, we're going to be looking at four different companies. The first two companies are lending companies that could capitalize significantly on interest rates dropping in 2026. The second two companies are in a vastly different position. They are two quantum computing companies. Quantum computing is expected to be the next big thing when it comes to AI. And a lot of investors have been getting into these companies, but I want to give a warning on what to watch out for when it comes to these small quantum computing companies. But let's go ahead and jump right into it. The first company that we are looking at is Credit Acceptance Corp. Their ticker symbol is CACC, and over the course of the last year, this stock is up only 3.4%. And what's very interesting is if you look at the last 5 years, the stock is up only 30%. However, there was a very large run up from 2020 all the way through till 2022, where the stock moved up by around 130%. This company currently has a market cap of just over $5 billion, so it is a relatively small company. The reason I point out that time period from 2020 through till 2022 is because this company is in a very cyclical market. What they do is they provide loans for people looking for vehicles. What happened during 2020 through till 2022 is a lot of people were going out and purchasing new or used vehicles. If you remember driving past any dealership, they were offering significant amounts of money for used vehicles to try and get you to trade in your vehicle so they would have additional inventory. Because inventory ran out, this was due to a couple of different things. Obviously, we had the pandemic and a shortage going on in certain components, but also with interest rates being very low, people were looking to purchase new and used vehicles. And these loans, on average, last around 70 months. That's between 5 and 6 years. 5 years from 2021 would be 2026. 6 years from 2021 would obviously be 2027. What that means is over the next 1 to 2 years, especially if we see interest rates come down, some of these people could be getting out of their car loans and look to purchase a new vehicle. What Credit Acceptance is actually seeing in terms of loan volume is a decrease year over year of about 15%. In my opinion, this is not very concerning. This is a small drop, and what it actually likely means is people see interest rates potentially dropping in 2026, maybe even in 2027, and that resulting in them putting off getting a new car this year in anticipation of lower interest rates next year. And overall, the company appears to be in a good position heading into this potential growth period. Last quarter, they brought in $7.42 of GAAP EPS. The quarter before that, it was $8.66 of GAAP EPS. And they're using this money to buy back their own shares. They reduced shares outstanding by 4.5% as of their most recent quarter. For cyclical companies, it's a little bit difficult to look at valuations. Right now, the valuation on this company is sitting at a forward P ratio of a 10.34, which seems low compared to the broader markets. However, again, because these earnings can kind of vary significantly over these time periods where they see increased volume, that's why a lot of investors don't really pay attention to valuation for companies like this. And I would suggest doing the same thing. I don't think looking at this 10 PE ratio necessarily means that it's a screaming buy. What you need to pay a lot more closer attention to is what is happening in the broader economy that could result in some short-term increases in companies' performance. Right now, I don't think this is fully being priced into the stock. For the current year, analysts are expecting $37.13. That is actually down year over year from their 2024 EPS of $38.41. But in 2026, they have a $6 increase in EPS to $43.15. I think that this number is a little bit low. And then I do think that this will actually continue into 2027. And I think when that occurs, this stock should shoot up maybe 20, 30% in the course of a year, year 1.5 year kind of time period. And that would make this company around a $580 to $600 stock over the next couple of years. The next company we have up here falls into a similar category. It's Lending Club Corporation, ticker symbol LC. Right now, they have a market cap of just under $2 billion. The stock year to date is up only 2.5%. However, from the lows back in April of $8.50, this stock is up almost 100%. In terms of their business model, Lending Club was the first peer-to-peer lender. Since that time period, they've really branched out to a number of different products. They're really a fintech company at this point, offering customers different ways to refinance existing debt. And this is a massive market. Revolving consumer credit is now sitting at $1.3 trillion, very close to an all-time high. And what we are seeing from credit cards is all-time high interest rates. The average credit card interest rate is now sitting at 21.2%, again, very close to an all-time high. And companies like Lending Club, as well as SoFi and other kind of smaller banks, tend to benefit from lower interest rate environments because what it often leads to is consumers refinancing different forms of debt, whether it's credit cards, home loans, student loans, car loans, whatever it may be. They will look for lower interest rates to try and reduce their monthly payments. And Lending Club is already benefiting from some of this. They saw a 33% increase in revenue as of their most recent quarter, bringing their revenue to $248.4 million. And this improvement wasn't only on the top line. They saw this translate as well to their bottom line numbers. Net income grew from $14.9 million in Q2 of 2024 to $38.2 million in Q2 of 2025. That is a 156% increase year over year, or on an earnings per share basis, that was 13 cents back in 2024 to now 33 cents in 2025. The benefit of a small company like Lending Club is that they can grow in a couple of different ways. One way is macroeconomic conditions changing, like we have talked about, and that benefiting the business. The other way that they can grow is just by getting their name out there more and accruing more members. Right now, they have around 5 million members. They could see this increase over the next couple of years, and that can also benefit the business in the long run in a major way. In 2024, they put up EPS of 45 cents. Analysts in 2025 expect that to grow to $1.03. And then they're expecting that to grow even further in 2026 to $1.37. For 2025, analysts are expecting top line revenue to grow by about 25%. This could be a little bit low, especially based on what we saw in the most recent quarter of 33% growth for their top line. In 2026, they actually are only anticipating revenue to grow by 15.5%. This, in my opinion, could be a low estimate. If we see again interest rates drop, there's no reason that the Lending Club couldn't increase their revenue and maybe even grow faster than we're seeing in 2025. The only thing that worries me about this business is they are trading close to multi-year highs around that $16 to $17 range. I think that that could be a concern. I like buying companies when they're on a dip. I don't think you're going to get it for this $8 to $10 like we saw back in April anytime soon. I think what we see in 2026 is potentially another leg up, maybe to that $20 to $25 range. This is the part of the video that I was most excited to make because I think this is very interesting. We have seen a lot of comments recently of people talking about AI and what effect it really is having on the broader economy. A lot of people are comparing this AI boom to the internet boom. And I think when it comes to Nvidia, AMD, some of those larger companies, I don't see that as being true. Those companies are actually putting up solid earnings. But one subsection of this market that has seen a massive increase in stock price has been quantum computing. This company alone, which is D-Wave Quantum, their ticker symbol is QBTS. It has increased by over 2,500% in the last year. And another company that is a little bit more well known in this market is IonQ. Their ticker symbol is IONQ, and over the course of the last year, it has gone up by almost 700%. They now have a market cap of over $21 billion. dollars. I'm not going to pretend to be an expert on quantum computing, but my understanding of this is classic computing uses something called bits. These bits can either be a 0 or a 1 at any given time, and that's basically how code is written. Quantum computing, on the other hand, uses something called qubits. They can be either a 0 or a 1 or both at the same time. And the reason this is so important is these quantum computers are able to solve very complex problems quicker than ever before. And the thought is that these computers could eventually replace these GPUs that are used in AI. However, here is the problem when it comes to these quantum computing companies and how it relates back to the dot-com bubble. For IonQ, they brought in $20.7 million of revenue in the second quarter. This is a company that has a market cap of over $21 billion, and they are only bringing in a top line revenue number of $20.7 million, let alone all of their losses on their bottom line. For the year, they are only expecting to bring in between $80 and $100 million of revenue. That means that this company right now is trading at a price to sales of around $300. Over the long term, sure, these quantum computing companies could replace the AMDs, the NVIDIAs of today. However, right now, they are losing money and they are not even growing that quickly. Year over year in 2025, they're only expecting revenue to grow by 112%. I say only because a couple years ago, NVIDIA was growing their revenue by 150, 200% year over year. And they were doing that and also growing their EPS numbers. Right now, these quantum computing companies are growing at slower rates than NVIDIA was a couple years ago, and they aren't even able to translate that into appreciable earnings. So the warning for investors is don't get caught up in the hype. Make sure you are paying attention to the fundamentals of these businesses. I think if you want to invest into them, maybe a 0.5%, 1% of your total portfolio is okay. But if you start going over that amount, I honestly think that you're playing with fire. I think a lot of these companies, you could see a major dip over the next couple of years, and maybe that's the buying opportunity. A lot of them will kind of go through this hype phase, and then they will see a massive pullback as a lot of investors get tired of not seeing a return on their investment, and they'll end up selling out. And that's a very good time to buy in, because over the next couple of years, if the story actually plays out, they could see massive growth and then finally be able to translate that growth into strong bottom line numbers. But of course, let me know your thoughts down below on all four of these companies. Do you own any of them? Are you watching any of them? And what do you think about quantum computing? Is it going to replace these GPUs that we currently have in the market? Let me know all of that down below. And while you're down there, drop a like on the video and subscribe for more videos like this one. And as always, have a wonderful rest of your day.